Hello guys, I hope everybody is doing good. Can I get a quick confirmation on chat that if you can see me, hear me and see the screen properly? सबको मेरी आवाज clearly सुनाई दे रही है? Can I get a quick confirmation on chat? Okay, perfect. We're going to be starting out with this session. So we're going to be doing the second half of the book one, and the focus over here is on the arbitrage pricing theory. Okay, we completed the modern portfolio theory in the last session. Now we're going to be focusing on the arbitrage pricing theory, which is also called as APT. Okay, now over here from the exam perspective, okay, they will mostly be asking you a theoretical question. Okay, they might ask you the pharma French related calculation based questions, some of them. Okay, but more or less the concepts are theoretical. Okay, so when we start about this chapter, the important thing is how our capital pricing capital asset pricing model is different than the APT model. Or basically you have to think it this way: what are the problems that were there in the capital asset pricing model and why people actually move towards APT? Because capital asset pricing model was not telling you any specific factors, capital asset pricing model was only saying that you are going to use a market factor. But when you go to APT, it gives you the freedom, it had more flexibility. Okay, so this is one thing that you need to remember. Okay, that we were not only focusing on the market return, or we are not only focusing on the S&P 500 or index like that. Okay, so APT was new approach where you could take multiple variables. What are those variables? GDP, interest, S&P 500 and all of that. So that can get tested in your exam. So remember that. Okay. Further, from the exam, from this formula perspective also, what GAR can test you is what is this F? F means what is the deviation from your expected part and what is actually happening. Okay. So if you look at this F, it is basically talking about the risk factor, and they're talking about the deviation. So how does this deviation helps? So when you go forward, they're talking about that, okay, initially my expectation was that the GDP is going to be 3% and then it came down to only 2%. So the deviation was negative 1%. Okay, that is one thing that that should be very clear in your mind, that what does F do? Okay, from the exam perspective. All of these assumptions are very important. Do not miss this. Okay, why do people enter into this into the market? Because they want to maximize their profit. Okay, next is markets are frictionless. That means you can enter and exit very fast. There is no taxation, there is no transaction cost. So all of this is very fast. A lot of people in the market right now, they have a short selling biasness, or basically not biasness, they have short selling restriction. So we are also assuming there is no such restriction right now. Okay. And lastly, there is no arbitrage opportunity. What does that mean? That when you look at this formula, there are factors. These are macroeconomic factors. They are the ones which are actually there and which are driving the returns. Okay, there is no arbitrage opportunity available, which means whatever the factor is giving you the return, whatever the calculation is giving you the return, the real return is almost same. Okay, the real return is almost same. That is what they are highlighting. So we have always compared the initial value for factor F. Yes, Paras, answering to your query. So whatever was the initial expectation of that macroeconomic factor, okay, how far you are from that reality. So what is the deviation? That is what they are checking. Okay, the rest all is not so important, so don't worry about much this section. The core part is also okay. Multi-factor models, when you enter into this, is basically explaining the formula. So over here, this is something which you should remember, understand, that error part. So in the model, we are using independent variables which are nothing but your macroeconomic factors like inflation, GDP, consumer sentiment and all of that. What is that E part? E part is a firm specific factor, which is nothing but idiosyncratic risk. So when you're creating a portfolio with multiple assets, these idiosyncratic risk will also become zero. So they will actually not get impacted. They will not impact your returns much. Why? Because at a portfolio level, we are getting a diversification benefit. Okay, so that is that idiosyncratic risk concept and how it is connected to your error. That is also important for your exam perspective. Beta, to a very certain extent, if you're doing your regression and chapter, then this will get covered over there also. What does beta tell you? What is the sensitivity towards a particular independent variable? So that part is generally covered. Okay, more or less this part is simple. Calculating return. Now, generally this kind of formula or this section where they are giving you the betas, they are giving you the factors, and then they are asking you to calculate the return. What if the institute wants you to test on this concept? What they will do is they will ask you to calculate the answer, and they will ask you to take a decision. Okay, a decision related to your portfolio, decision related to your asset, like that. So very high chances that they can combine this with some theoretical question. Okay, now over here what they have given you all of this. Like for example, what is the expected return? This means this much. What was the initial expected return of that asset, HCI? Okay, then what is the factor that you have taken, GDPI? What is the sensitivity to? What is the expectation? Initial expectation was 3.2. Then you realize there is something else. Then you realize, okay, it is actually only 2.6. So there is a deviation. So in a simple language, what you are doing, initially the HCI is expected to give me 10%. When, how will it give me 10%? When the GDP is going to be 3.2%. But the GDP has gone down to around 2.6%. So automatically my portfolio return will also go down because my portfolio is dependent on that factor. Okay. But how much the GDP impacts, whatever is the change into that 2 will impact the final return of HCI. Okay, that much down it will come. So it will come down by 8.8%, which is basically calculated over here. But I'm just explaining you the concept. Okay, so theoretically they might also ask you a question regarding this formula. Okay, explaining you that how does this deviation impacts? Okay, how does this deviation impacts? The next example that you see is also almost same. They have taken 2 factors now. Okay, but the concept is same. The concept is same. You can add 3rd factor, 4th factor, and you can keep on doing the calculation. Accounting for correlation, over here, again, the logic is same. If you have higher correlation, higher chances of losses, because everybody is going to behave in a similar way. Okay, so what generally companies do is they try to create a portfolio with different asset class. So for example, I have certain stocks from equity, certain stock from commodity, certain stock from gold. Likewise, so I'll try to make sure that different asset class comes, because if I'm only creating a portfolio of similar asset class, the correlation will be higher generally. Okay. Main conclusions. This section is something you can read. What are the major conclusions of APT? Okay, APT generally works when you have a well-diversified portfolio, because when you have a well-diversified portfolio, your error term, which is a firm specific part, will not be impacted. Okay, and everything then boils down to what is the factor and what is the factor beta. Okay, now this last section basically tells you that even though, suppose I have a portfolio and in that portfolio there are, like, say for example, 100 assets, everybody might not follow all the assumptions of APT, but majority should follow. Then only we can say that the portfolio is in sync. Okay, so that is what they are highlighting. We cannot conclude that APT relationship will follow for all the different assets, all the security. Okay, but even if majority of the securities are following this relationship, then we can say that the arbitrage relationship is there, or the APT relationship is there. 1 or 2 assets not following it will not create a big problem. So that is what, if you read this, we conclude that APT relationship can hold for well-diversified portfolio, even if does not hold for all the security. 1 or 2 securities, 5th security is not following, that is okay. This is something which you can remember for the exam. Hedging exposure. Hedging exposure, the concept is very simple. Okay, now I have not heard that they have tested exclusively on this concept in the history. Okay, but if they ask you to talk about this hedging factor related part, suppose I have a portfolio P. Okay, there is a factor 1, there is a factor 2. Okay, both of them are impacting this portfolio. So beta of the factor 1 is 0.7, beta of the factor 2 is 0.3. What I can do is I can create a first factor hedge portfolio, which means I'll create a portfolio in such a way that only the factor 1 is impacting me, rest all the factors are 0. It is not impacting me anyway. Now once we have this factor portfolio, what ideally I can do is I can basically, okay, suppose I take a position of take a long position in the original portfolio. Okay, and similarly if I take a short position in the factor 1 hedge portfolio, how is it going to impact? So finally it is going to look like this: 0 positive 0.7 coming from the portfolio, okay, and positive 0.3, but the hedge factor portfolio is bringing -1. So this will get nullified. This will get nullified. So I can, if I want to make a proper nullification, what I will do, I am going to take a short position in 70% of this portfolio. 70%, so that this beta comes to -0.7 and it cuts and it nullifies the factor. That is the core concept that they're trying to help you understand. I'll go slightly up to explain you much better. Okay, so over here also, suppose if I take a long position in the first portfolio and if I take a short position, this and this will get nullified and I will only have an exposure to this factor. That is what they are trying to help you understand, this entire concept, entire series. Okay, now they are explaining you variety of ways through which you can hedge. If you read this section over here, they are talking about how I can benefit from it. Suppose I have a hedge portfolio. Okay, suppose portfolio 1 was having 12% return. My hedged portfolio had only 10% return. So what I can do is I can take long position in the portfolio P or the portfolio 1 and I can take short position in the hedge portfolio. The difference of 2% is what I am going to make. Okay, so they have given you that basic example, not very heavily tested in the section. This challenge can be theoretically asked. You can read this part. Okay, what are the challenges that we are talking about? See, we assume, one of the very basic assumption that we do is that the factor betas will remain constant. That is not true, because the betas can change over a period of time. That also needs to be considered. Okay, because we assume that the underlying asset, everything is going to remain stationary, but there is going to be a change that we need to incorporate. Okay, next is, see this one also, factor sensitivity have changed. So how the factor sensitivity will change, how my formula will change, how my answer will change, that analysis needs to be done. Next is trading cost. When we talk about trading cost, this is important. In terms of theory, they can test you if they want to ask a question from this chapter. Trading cost, which is nothing but how do I rebalance my portfolio, how do I get new asset, sell new asset, sell the asset. So at an overall level, what will happen? At an overall level, it will have an impact from the returns getting reduced, because your cost is increasing. Okay, so that change has to be analyzed and that change has to be incorporated into your decision making of your formula ideally. So this is the overall part. The most important section of the chapter is pharma fringe. Okay, so from the exam perspective, you need to understand what are the factors which are there in the pharma fringe. So the first factor is the market return, which is nothing but RM minus RF, which is also used in CAPM. Okay, the second factor is SMB, small minus b. So you basically you create a portfolio of smaller companies, you buy the smaller companies, you sell the bigger company. The logic over here is that the smaller companies will grow faster and the bigger companies, mature companies, will not be able to grow faster. Okay, the returns of the bigger companies is going to be small, very stable, but the smaller companies, the returns are going to be exponential, it can be very high. The third factor is high minus low, which is also given over here, high minus low, but they're talking about book to market metric. What is the book to market metric? So if I'm going to write the book value of the company and the market value of the company, suppose tomorrow I'm talking about Tesla. Okay, the book value, they have so many assets available and all. So the book value talks about the historical value of the asset which is there in the balance sheets. Okay, but this market value represents the share price. So what happens now? Okay, if tomorrow there is a bad news, this share price will go down and the market value of the company will be lower than the book value, which means this is a very good example of a value based product. Okay, so you should buy this product, and whenever your denominator goes down, your the overall ratio will shoot up. So you should always buy a high book to market value company, okay, and sell minus low book to market value company, minus. Okay, that is what you should know for the exam perspective, and the formula is over here. Now one way you can look at pharma fringe is this, that ideally this is my CAPM. Now why I'm saying this, because RP, which is nothing but the risk premium. Risk premium means RM minus R. This is your CAPM. So you're actually taking CAPM and you're adding two new factors to it, which is SMB and HMB. Okay, so they can test you in that format also. that whether CAPM and SM pharma price has some relationship or not. Okay, this is the same concept that I talked about. This is not important, that okay, you can add more extra factors, not very important. This calculation is can get tested, so mark it as star. Basically, they will give you all the input. They will ask you should remember the formula and you should know how to use it. Okay. Alpha is nothing but what they are trying to highlight is, suppose pharma French calculated and got a return of 13.66. The real return is higher or different. Then there is something extra which is not getting captured in the three factors that have been added. So that is because of the firm specific factors. Okay, and that is being covered in the extra or deviation from what the formula is actually calculating. Okay, I hope everybody is with me till this point. So we have completed this chapter. Can I get a quick confirmation on chat? सब लोग हैं साथ में? Okay. The next part, principles for effective data aggregation. Now I know this is a very boring chapter, slightly, okay, because what happens is that very heavy theory. Okay, now in this also, what you can do, you can try to focus on how they can test you, or what are the things that are slightly critical. Okay, again, you can read this chapter at the end. Okay, at the end of your entire 62 chapters, before going to the exam, just quickly read it. Okay, data quality, governance and infrastructure. Now in the first section, they will if they want to test you from this chapter, the most likely thing is this entire thing. So mark this as star. Basically, why data quality is so important? Why do you need to look at the principles and all of that? Okay, so they can tell you how if you have a good data quality management process, then you will end up having a good business processes. You will be able to identify the problem. If there is a problem already, you will be able to come back to normalcy. So this section, again, theoretical, very common sense. Okay, but questions will be more scenario based if they ask you. Okay, resolvability is most likely they can test you. There's a question also in your Kaplan book talking about it. So resolvability, that means it increases your chances of solving the problem because you have good amount of data available. Okay, so that is, this section is what you can remember, how what is the need for the data quality checks. Okay, the next is challenges. I have not heard that the challenges are explicitly being tested. Okay, because model risk related concepts are generally tested in level 2. Okay, generally, so you can just read it, but it is not that very important as such. Data duplication and all. Okay, so actually this entire chapter focuses on BCBS rules or principles that were connected to the analysis of quality of data, risk data actually, and the risk data aggregation, how the data is getting added and shown at the top. Okay, so that is the BCBS 239, which has certain set of principles. Okay, which they expect the banks to follow, the global banks to follow. Now this part, this is something which you can read. The purpose of giving this principle is to help identify till what level of risk the banks can actually take. Okay, and what is the overall level of different types of risk that the bank can face with respect to data quality. So that has been highlighted. Again, model developers and all, you can read broadly. Key governance practice. Now when we go to the first principle, okay, now first principle is more about governance. Now this has become very important lately because a lot of banks have started facing this issue. Okay, what is the issue that they have faced? Governance related problem. That means they might have the processes, they might have the structure, infrastructure, framework, everything, but the governance is not there. So there is no checks and balances that are happening. So how do we manage that? Independent review, documentation. Okay, these things can get tested in theory part. Okay, also this part, if they want to ask you, they can give you a case that okay, you are doing a merger and acquisition, you are doing some divestment, restructuring in your company. From the data perspective, what should happen? Okay, so over there they might combine this and one of the other principles. Okay, whether the accuracy is important for you right now or whether their completeness is important for you right now, like that they can ask you a question. So whenever this acquisition, divestiture, or what do you say, restructuring is happening, okay, you have to always focus whether there is data aggregation is happening effectively or not, whether there is any challenges that are happening or not. Okay, and then you have to see whether the integration is happened properly. You have to do a lot of beta testing. You have to see post the merger also whether the systems are talking properly to each other or not. You have to keep on doing that. That is one thing that they can test you. Data architecture, infrastructure, very least likely that they can engage in these kind of questions. Okay, so you can read it once. Accuracy and integrity is important for the if you look at the question format structure. Okay, so they can ask you like this: how do we ensure that the quality of the data is mentioned? So they will give you 4 steps in the options, and you have to choose which of the steps option best matches the requirement. Best matches the requirement. Okay, so kind of the quality of the data. How do you do? Reconciliation is one step. That way you can hire dedicated risk professionals team who are there and who are going to manage, who are efficient enough to manage the risk effectively. Likewise, so they can test you over there. Theoretical chapter. This one also, there's a question in your book, okay, which talks about that because the automated transaction failed. Okay, now you have to do a manual workaround. Whenever you do manual workaround, you have to be very cautious, because you have to be clear that whether the manual workaround will increase the risk or not. Okay, you have to get it documented, get it approved, and all of that. So this manual and automation, try to make sure that as much as automation as possible. And if there is a manual workaround which was important, how do you take care of it? So in the book also they have given you a question. Completeness, in the completeness, this off and on balance sheet. So they can give you a question in a scenario format that I'm a very big organization, I have 3-4 entities here and there. What kind of risk I might face, okay, with respect to data? So completeness, because on balance sheet entities might be considered, but on balance sheet entities are not considered. This is something which they can ask you, okay, in a very scenario based format or a conversation based format. There are 2 analysts who are talking and like that. Timeliness section is okay. The stressed part, that means during stress period also the report should be available in timely manner. That concept can be effectively tested. There's no need for you to remember all of this. Okay, this is basically part of the critical risk that you're covering in your reports. So adaptability is also okay. This part, data must be customizable. Now again, if they are asking a question, they might ask a straightforward question: which of the principal focuses on the anomalies in the data? Is it the completeness? Is it the accuracy? Likewise. Okay, so when you create customization, okay, how do you take care of that? How do you take care of the anomalies, the problems that come out? That can be effectively tested over here. And this paragraph, which principle is more important for you? Is it the accuracy, completeness, timeliness, adaptability? Which principle? So ideally all the principle has to be managed. See, when you're giving the data in a timely manner, it should be accurate, it should be complete, or else what is the point? So that can be tested. Your manager has asked you to give this. Which of the principles you will give more preference, or you will give equal preference to everybody? Likewise. Recent report, effective. Again, slightly repeat that if your data aggregation is correct, then what is going to be the benefit, what is going to be the problem, all of that. Accuracy, this accuracy is more from the reporting side, not from the data side. Okay, so over here, the scenario analysis sensitive, because everything will go into the report. So your report has to be strong. Okay, then only the real picture will be reflected. So they can ask you something on that format. Again, the same repeat. During regular period, during stress period, everything should work as expected. Comprehensive is okay. See, comprehensive can be tested in this manner, that they will give you some details about the company's risk, and they will test you that whether the reporting that the report that has been generated, is it actually covering all the relevant risk or not. That way they can test you. There's no need for you to remember all of this. This is just being given to give you perspective. Clarity and usage is okay. This section, when you do reporting, whether the risk is up to a mark, up to a level, whether it is within the tolerance level or not, that is basically being expected. Frequency is also okay, not very important as such. See, this part is something which can get tested. What they are trying to highlight, see, your frequency should be determined on the basis of what is the importance of that report or whether it will create any impact. Okay, next is when the market situations are changing, your frequency should also be changed to take that into consideration. Okay, so that way, like for example, they are giving you, if there is constant increase in the volume, then how do you manage the frequency of the report? Because the report generation will not happen as per requirement, because suddenly the jump has come. Okay, distribution is okay, very basic. So we have completed the chapter. I've tried to give you just because, again, do this chapter at the end. Don't take the pressure that I don't remember what is the principle. It is not expected that you remember principle 10 was this, principle 11 was that, is not expected. Okay, we're going towards the next chapter, which is enterprise risk management. Okay, future trend, again slightly theoretical. If they ask you a question, they will be more focused on the CRO related part, CEO related part, what decision they are going to take, whether your ERM system is efficient enough or not. Like that, they can test you. Enterprise risk management and what are the future trends? Silo based risk management. So historically, what was happening, the way banks were analyzing risk, they were more focused on, say for example, a market risk team will only think about market risk. The credit risk will only think about that. So effectively, what was happening? Nobody was connected. Okay, nobody, the senior management was not able to get a macro view, and that problem is actually being reduced, because if there is a connection between one risk type and the other risk type, if one risk is offsetting the other risk, we had no way to analyze it, and that is where the enterprise risk management came into picture. So that initial thought process should be clear to you. Okay, and that is basically being explained on all of these paragraphs, but that gist should be clear. Again, similarly, this part, I don't expect GARP will explicitly test you, okay, how the hedging is happening over here and all. Explicitly, they might not. Okay, ARM motivation, yes, this can be asked in a theoretical question, in a way that, okay, your manager is proposing ERM framework in your company, and he has highlighted two different benefits. Which of the benefit do you agree with? That kind of question can come. Okay, so over here, if they want to ask you, this section is important. This, in the sense that I'm thinking from the perspective that if they want to create a question, how will they create? Okay, this one also. So basically, if you look at this, whether the ERM will be able to identify that whether the risk is above a risk appetite level or not. That means even if I'm creating a risk appetite statement, I need a method or a way to calculate the risk, and that is what ERM is providing. Okay, next is top 10 risk of the organization, top 10 losses that the organization has faced in the last quarter. That can be tracked through the ERM framework. That is what they can test you. Okay, crossover is nothing but if one risk is increasing, some other risk has a connection to it, or some new risk came into picture. If you have a strong ERM framework available with you, you will be in a position to connect that. You'll be able to connect to understand that how the additional risk is impacting you. Okay, because you have taken a step. So that is one of the very strong benefit of having an ERM. Okay, total cost of transfer, you can also read this. See, generally companies, they have a centralized team to do things. Why? Because if individual teams start doing it, what will happen? I will also take insurance, somebody else will also take insurance, and we will end up paying more premium. So to avoid that, you need to have a centralized system to take care of the overall impact. Okay, so this is the major ways ERM motivation, that the why companies want to enter into that. Best practices, again, the primary focus will be on the corporate governance. That's what I expect. Okay, where they will ask you how do you manage the corporate governance, whether ERM will help you to manage. Okay, so they might give you some statements, and you might have to say whether the statement is right or wrong. Likewise, they can ask you a question. So risk appetite statement, tolerance level, effective framework, that if everything is integrated to ARM, then it becomes very easy. All of these things. Okay. Before we move ahead, Vedant answering to your query from where we can get a GAR sample paper. It is available on your portal. Na? GAR portal, it should be available to 2024. I'm sure other people have already solved it. Okay. Let us go to the program dimension, more or less which section is important. 1 second. This part they can try to test, because see, when we talk about ERM, the ERM has to be created at a company level, at overall company level, okay, firm level, so that we understand what is happening in each businesses, each entity, what is the overall risk, okay. And because once we see the overall picture, macro view of the company, then you can take a decision. And over here they can connect the first chapter and this chapter. What are the decisions that we are thinking about? Okay, avoid, retain, mitigate, and transfer. That decision making can be done. So they can connect it like this. Okay, culture is very, very important. You have the best of the best system, but the culture is such that you have to cheat, then it will never work. Okay, so culture is the heart and soul. This culture related questions you might see a lot in your book 1 in the exam. So in the past 2 exams, I've heard a lot of students talking about this, that majority book 1 questions were related to culture, related to CRO and all of that. Okay, so definitely the question can come like this. Strong corporate culture is okay, is important for your ERM framework. Risk culture, okay, these are just the frauds that has happened in the history, so they've just given you the brief. These key culture indicators, how do we define that the culture is good? Okay, so that way, openness to dissent, this section can be tested, that whether something is happening, they have given you a scenario whether it is good for the ERM or not. That way they can ask you a question. Next is knowledge of the firm's appetite. If you do not have a firm's risk appetite, you will not be able to identify what is the level of risk that we can take. Then you cannot go into the details of calculating the risk through that way. Okay, so firm risk appetite level should be good. Whistle blowing and escalation, again openness to dissent, and this is connected. So whether there's a mechanism through which you can blow the whistle if there is a problem that is happening against the company. Okay, identification of risk culture and incidents. If certain bad things are happening which is actually impacting the culture, do we have a mechanism through which we can track and we can take care of it? That way they can test, they can ask you a question. Risk indicators become risk levers. This one, the risk will change across time. That means the current level of risk that you're looking at, it is not going to be constant. Okay, it will change. Okay, so that way they can identify the question. And this one, the cultural cycle. Today you faced a problem. It's very basic, simple. Suppose I'm going for a CFA exam. I failed CFA exam. Okay, so because the failure was there right now, the pain is very high. But as I move away in time, the pain will subside and I will forget. Okay, I'll forget. So that is very, very basic problem. Okay, so cultural cycle is something where they can ask you a question. Scenario analysis, advantage is okay. This one, warning signal, why do you do scenario analysis? You can ask you a theoretical aspect of that. Disadvantage, complex, and whether we are actually creating right scenario or not. We have a team, everybody is happening, but we missed on that scenario which actually happened. That is problematic. Next is identifying probabilities, also very, very interesting part. Okay, more or less is good. Long-term capital management, any which ways, it is getting covered in the learning from financial disaster section. So that is not very important over here as such. But this section, that now the regulators are also asking banks to have a proper stress testing program. Okay, proper stress testing, like for example DFAST, then your CCAR. Everybody is saying that if you are above a particular level, you have to run a stress testing program. Okay, $50 million, $10 million. What is this? Basically regulatory intervention. So they might not test your direct numbers. They might ask you what is the mood of the regulatory, change in the mood of the regulators historically, what was happening previously, now what is happening. So that way they can ask you to question. This is important. Baseline, adverse, severely adverse. So when I'm creating scenario, I'll create a baseline scenario, which is very basic situation. Slightly adverse, okay, my sales are going down by 5%. Severely adverse, sales are going down by 30%. Okay, so like this, they can test you. So these 3 pointers can be asked in theoretical questions straightforward. Next is, okay, more or less COCO bonds, contingent convertible bond. Now, if they want to make this question from this chapter slightly tough, they will go into more detail of COCO bonds in terms of the question. Okay, like for example, why there is a need of COCO bond. Okay, why would an investor purchase a COCO bond? What happens in a COCO bond, like that. So to get converted, if there is a contingency, if there is a problem with the company, if the ratio, particular liquidity ratio or particular regulatory ratio goes below a certain level, then we say that there is a contingency. That means then the bond will get converted into equity. Now, whoever are the bond holders, they will not get any money because the equity prices will be low ideally. Okay, and for the company, what happens? It adds more capital because now your bond is getting converted into a permanent equity, which is kind of an infusion on your, at least in your book, it is an infusion for you. So tier 1 capital is your Basel capital requirement. Those things, again, this part is not tested. Okay, that because this is going to come in your level 2. Most importantly, what they're going to do is they're going to focus on the COCO, how COCO bond can be used, or what is the impact of COCO bond. Likewise, they can test it. More or less, okay. Reverse testing. Now, historically, they were not very focused on that, but now in the last exam, some of the students said that, okay, they got questions related to reverse testing. Now, that basically means that you are actually going to look at a worse situation, that, okay, company has become bankrupt. You will come back and see which situation can lead to that bankruptcy. Okay, so it is basically a reverse part, okay, reverse testing. Okay, so you basically say that bank can work backward where a scenario happened, and then you see why the scenario is happening, which are the factors that can impact you. Okay, so that is very interesting. A lot of questions can come related to risk limit, not specific to this chapter, but something connecting the overall concept that we are testing, operational risk related part, that whether the risk limit is managed properly or not, whether the overall there's a limit breach, how do we track that, like that. So those questions, checks and reasonability of capital plan, that means whether we have a capital plan and who is checking that capital plan. All of these things are more or less the same discussion point. See, this kind of structure, that they've given you some basic part, then they've given you 2 statements. Now you have to read the entire question, read the statement, and then come back and say which one is right, which one is wrong. Most of the time they will ask you which one is not wrong, right? Like that they will twist. Okay, so we've completed this chapter. We're going to move forward. Learning for financial disaster, very, very interesting chapter. Okay, everybody who's preparing for the FRM level 1 should not miss this chapter. Okay, broadly you should not miss. So let us go. I hope everybody is good till this point. Paras, answering to your query, how many number of questions we expect from these 2 chapters, principal and ERM? 2 or 3 maximum. I expect one question primarily, but slightly higher at an higher end. Combine three questions, something like this. Okay. I hope everybody is good till this point. Chapter number 9 we are going to start now. Learning from financial disaster. Now they've started with this liquidity risk related part and interest rate risk related part. Okay, so interest rate risk, the broader concept should be clear to you. How the bank will face problem. Okay, when the interest rate change, so wherever I'm borrowing, okay, suppose I'm borrowing for a short period of time and the interest rate goes up, what happens? My cost of borrowing will go up. That is where the SLN industry started facing problem. Okay, so a lot of these SLN industry, they were borrowing borrowing money at a very short term. That means they were taking money in deposits for a short period of time, but they were investing at a long term loans, and they were trying to earn profit from that spread. But the major concept that they were relying on, that they will be able to keep on raising for a short period of time and the rates of short period of time will remain same. That was wrong. Okay, so if you read this entire section, they are explicitly focusing on that concept, and they're this riding the yield curve. Okay, this riding the yield curve is important. Okay, so it basically tells you like this is my time, okay, and this is the percentage, the rate of interest, Okay, if suppose this is 3 year, this is 7 year, this is 15 year. So I might borrow money at 3 years. Okay, let us assume that the rate of return is 3%, and I will invest or I will give loan at 15 years for 15 years, which is a long term perspective, and the rate of interest is 10%. So the gap of 7% is what I am going to make. That is what a lot of banks were doing when the yield curve was positive, upward sloping, and which means that the short term rates are going to be lower. So they were borrowing at low rate and giving the loan at a high rate, high tenure, and the rate, the difference, that is what they were making. This concept is called as riding the yield curve. This concept is called as riding the yield curve. Okay, so that can get tested because that is a core of your entire concept of interest rate risk. Okay, and then when the interest Fed started increasing their rate of interest, so that way the overall cost went up, they went into negative itself, so they started entering into risky loans, and when they failed, and then the entire bankruptcy started happening. So more or less over here the lessons can be tracked. So every time when you're reading any case in your book, give more focus on what is the lessons that you have learned. So institute also will try to ask you whether you have learned from that lesson, or whether you learned from that case study or not. That is going to be the major focus. Or they will test you what kind of fraud happened, what kind of wrong thing happened in that case. That can get tested. Okay. So short-term liability, long-term asset, that mismatch, asset liability mismatch should not be there. That was a core part. That is a lesson that we have learned from this case. Then from the interest rate risk, we have moved towards the liquidity risk. That means whether the company has good amount of money or not available. Okay, whether they have money to pay back the short-term cash that is required. And the famous case that comes into picture is Lehman Brothers. Again, this is not an important case, but I'm just walking you quickly through this section. So they entered into a lot of securitization product where they borrowed for a very short period of time from, in terms of repo, in terms of commercial paper, and they use that money to invest into those assets which were long term. And when the market collapsed, when the crisis started happening, they were not in a position to roll over the repo, roll over the commercial paper, and there was a need to pay. And the asset that they had created, that was also going down. So that when they start selling, it was not giving them good amount of money, and hence they ended up facing an issue with respect to the liquidity. JP Morgan was also involved. They were also giving funding to Lehman Brothers, but they stopped because they realized that the asset that they were giving as a collateral was of no use. So repackaging and all this is again come in your mortgage and mortgage-backed securities chapter. Okay. Funding model, actually, see the main thing. Funding model actually created more problem for them, because what they were doing, they were taking huge leverage in the sense, okay, that the concept was that they will enter into derivative products, which was like structured product. Okay, and to raise the money, they were taking short-term loans and they were investing to long-term illiquid asset. Same riding the yield curve concept, but this became a big problem because they were not able to roll over. The liquidity was squeezed out of the market. Continental Illinois, the core part that you should remember, that the bank, Continental CI, basically they gave loan to they had a sector-specific concentration. They gave a lot of loans to your oil and gas industry, and the banks which were sourcing this loan, Penn Square, when the oil prices started going down, the Penn Square entirely collapsed, and because of which the Continental Illinois, they also went down, because they did not have sufficient amount of buffer to work against this concentration risk that they were facing. So they faced approximately $1 billion worth of loss, which led to the ultimate default of the organization. Okay, so they started raising from foreign market and all. That is okay. That is not the main part. Main part is what has happened in this case. Okay, and this too big to fail concept. Now we generally hear about too big to fail in your books, in your novels also, but this was the first case where the regulator had to intervene. Okay, Northern Rock is again same. You are entering into OTD model. Now this term OTD can be tested. In your bank chapter also OTD is there. That OTD refers to that whether we are in a position, okay, to look at basically we are doing securitization. So whether we are doing originate to hold or whether we are doing originate to distribute. Okay, so when we enter into the distribution phase, we are actually doing securitization. So that can create a problem. okay, if we do not manage the risk properly. So over here also they were borrowing for short period of time and they were entering into a lot of OTD products, okay, and they had a very diversified funding market. But when the crisis started going high, okay, from the US market, it started impacting all the European economies, okay, and this was a trigger point that Northern Rock was allowed to give dividend even though they were facing problem. They were allowed to give dividend and they went on to borrow money from England, Bank of England, which is basically nothing but the trigger point, because BBC broke out that news that okay, they are getting some emergency funding, the bank is not good, and it created a panic, okay, and that basically then the regulator had to come out and say no, we are giving 100% guarantee. So that part, so bank run is also one of the important part over here. So you can connect and think. Again, lessons that you learned. So this paragraph, how do you manage ALM? So you have to make sure that you make sure that the asset liability management is taken care, okay, because if there is an interest rate change, automatically you are going to get impacted because the duration of the asset is different, duration of the liability is different. That is one thing that you can do. Either you bring the duration closer, so you have to closely match, but every time that might not be possible because the bank will not be able to make any profit. Okay, that is the concept that they are trying to highlight. See, the loan tenures are often shaped by the borrowers. Why? Because I want to give 15-year loans, but you want to take 20-year loan. So it is also customer driven. So managing your asset is in your control. Managing your liability is in your control, but managing the asset is very difficult. So they have just given you that you can have an emergency liquidity fund with some other bank, like line of credit. So all of this can get tested. Okay, mostly the lessons part is important over here. Hedging strategy. See, the first part of this metal gazelle shaft, the hedging strategy. Okay, static. What is the static hedge? What is the dynamic hedge? All of these. Okay, this is just to help you understand that what was the problem that this case was facing. So they were doing a rolling hedge. So I'll give you a very basic, simple example to help you understand. Okay, suppose I'm deciding to sell 120 million barrels of oil to my customer, but I'm selling it in such a way that I will sell 10 every month, and this will happen for the entire 12 months. There's a separate video also on this on my YouTube channel, which is more detailed. So there is one way which I can, how can I hedge this, because there is a risk I'm selling. Okay, so one way that I can do is I can enter into a strip hedge. What is a strip hedge? In the strip hedge, I will enter into 12 contracts. The first contract is for 1 month, second contract is for 2 months, third contract is for 3 months, fourth month, fifth month. I will have 12 different contracts, each with $10 million. So it's a proper hedge, but there is a problem, because if I look at long maturity futures contract, the liquidity will be very low. This is the first problem. Second is, if I feel that the long-term future contract, when I reach near, the prices might go down. So it is better to lock them then, not now. Okay, so you expect the yield curve to behave slightly differently or in your favor if you wait. So that is the reason you don't go into strip hedge, and that is also what the metal gazelle shaft case talks about. They went into stack and roll hedge. Very simple. They went into stack and roll hedge, and they said no, we will enter into only one transaction, which is the near-term transaction. Okay, and that will be for 120. When we reach closer to the end of this first month, we'll exit from that 120 million and we will enter into one more 1 month contract, which is only going to be 110 million. So I will keep on reducing 10 till the time I reach the maturity, the 12th month. Okay, but I am stacking, I'm taking 120 million. So that is the critical part. Okay, I'm taking 120 million barrel position. Okay, and that is what created a problem, because what effectively MG case was doing, okay, in the MG case, okay, they had taken a long-term short position into a forward contract. Okay, but to hedge, they enter into a short-term long futures. Okay, the interesting part was, over here you have mark to market, over here you do not have mark to market. So when they enter into the transaction, okay, the future price was say around 100 and the spot price was high. It was at 150. So you said that, oh, the future price will go up and will meet. But after some time, the oil prices went down and you realize that, oh, future price is 100, but the spot price is 70. So future price is coming down. And because you have taken a long position in the futures contract, you are facing a huge loss. Okay. And that created a liquidity problem for the bank. Okay. So this is what the core of the MG case is. Again, this paragraph, what was the contract, is generally not important. Okay, you should know what is stack and roll hedge, what happened, what position they had taken into the case. That is what something you need to understand. And there is one more interesting part, because the product was so illiquid. Okay, the forward contract was illiquid, and they had taken volume, they had taken position into 55 million barrels. They had taken 55 million barrels, but the actual market position was very low. Right, actual market, the depth of the market was only 10, 15 to 30. So if you want to exit the entire 55 million barrel, there is no market available. So it automatically becomes illiquid. Okay, because of the sheer size. That is what they want you to focus on. Okay, I'll take a pause. I'll address the query. Okay, by OTT model, which risk is reduced? Credit risk or liquidity risk? No, when you do originate to distribute model, so for the bank who is doing this OTT, for them the credit risk is reduced, because whatever is not so good asset, they are just going to pass it on to the OTT. They will just restructure it. They'll put it in the pool and they will do the restructuring. Okay, and it also brings liquidity for the bank, because when they sell this pool, they get the money and they can engage into more loans. Likewise, Yashna, did bank run cause reputation risk for Northern Rock? Actually, reputation risk created a bank run, because when the news came out, it created a reputation damage and then the bank run happened. Okay, Urvashi, there is some accounting related issue also in this case. Yes, so in the MGRM case, the German accounting rules. So where they are saying that if you book a profit, you can show it only when you are actually getting. But if you are booking a loss, it has to be booked fast. Basically, they are very conservative accounting policy. So what was happening in this case? Okay, the futures contract, they were taking long position. The prices went down. They started getting margin call. So they started facing a loss. And because it was a loss and it was short loss, they had to book it. But they were also making a lot of profit in the forward contract. But these contracts were going to get executed after 10 years, 15 years, 5 years. So they cannot show it right now. So there was a mismatch, and because of the accounting standards, they had to show a lot of losses, and people felt that they are actually taking speculative position, and hence nobody wanted to give them loan also. Their credit rating also went down. Okay. This concept of backwardation contango has to be remembered, not only for this case but for your book 3. Contango backwardation, which price is higher, what happens in that concept should be clear to you. Properly constructed hedge. So the accounting rule is over here. This part is important. They had taken, because they had taken stack and roll, their position was so huge that if they start selling, so they were facing trading liquidity risk, and because they started selling, the position value also went down and more margin call came in. So it created funding liquidity risk also for you. This section you can read properly, the last part. With this, we have completed the first part. Model risk is generally not tested in level 1 as such. Like I said, level 2 is where they focus more on this. Okay. So what is the model risk? The model assumptions were wrong, model parameters were wrong, model was deployed wrong. Those issues basically. Now they have given you 2 cases, primary need offer and the long-term capital management is important. Okay, from the exam perspective. So Victor, he basically trying to take position. Over here they talked about harvesting put option premium. What is this? If I start selling deep out of the money put option, the premium is going to be mine. If the underlying asset falls very fast, goes very down, then only the premium is triggered. Okay, so then only the option will become in the money and I'll have to pay because I've taken a short position. So this is a very good way when the markets are not, you expect the market to not be volatile, you start selling the out of the money put option and then you make the premium. Okay, you make the premium money, so you're harvesting that. That is how they are correcting it. Okay, so they took, okay, 1 second. Just a second. Okay, numbers. It is very difficult to highlight numbers for us because there is nothing as such in terms of number. What they're effectively highlighting. See, you have to think it this way. I'll try. See, you have taken a put option. You have taken a short put option where the strike price is 1000. Okay, strike price currently the underlying asset is at 1000. Okay, 1180. You expected that this will maximum go up to like 5% down. In my example, this can go down up to, say, for example, 1050. Okay, this is the major level. Okay, this is something related to 5% down that S&P 500 was expected to go, but it went down further and it went down below the strike price, and all the options that you have taken short position entered into a in the money position, and now you have to pay back. Okay, now you have to pay back likewise. Okay, so the assumption that the historical level will always be followed, that means the market will not go down by 5% threshold, that went down because in reality it went 7%, and because of which the huge margin call that they were started facing, and they did not have the sufficient amount of money. Okay, so there is no free lunch. Free lunch means you cannot keep on earning premium just by taking short position in the options contract. Long-term capital management, interesting case, important case. The concept of economic leverage is important, where they're saying that you enter into position, and before entering you basically do not pay any margin, initial margin, and because of which what happens, you get economic leverage. Whatever money you have, you can go enter into infinite position, because everywhere you're not paying any margin as such. You're not paying any margin as such. Okay, so that is one concept that has been highlighted. Okay, that is the one concept that has been highlighted. Okay, and their position was very huge, $1 trillion worth of asset that they had taken. Okay, significant. So next, first problem is economic leverage, and the leverage was very huge. Okay, because it is not only the balance sheet leverage, it is also the economic leverage, because everywhere they were waived off with the initial margin concept. Okay, so nobody was asking for any initial margin from them. The core strategy is the relative play. What is the relative play? I will take long position, short position in such a way that it ultimately gives me profit. Okay, long position, short position. So wherever I've taken long, the price will go up. Wherever they have taken a short, the price will go down. Now they have taken the long short in such a way. So for example, the two different corporate bonds. Okay, so I've taken position in, say, US government bond and a Russian government bond, short position in Russian bonds, like that. Okay, so buying one asset, selling one asset, trying to get the benefit of the perceived price difference. Okay, and they had taken position in such a way that the overall volatility will come down, overall liquidity will increase in the market likewise. So they were focusing both on systematic and the volatility risk. They assumed that the market will remain stable and the volatility risk will come down, but Russia defaulted. When Russia defaulted, all the market started volatility increasing. When the volatility started increasing, the position where they had taken long, they started going down, where position where they had taken short started going up. So in both the positions they started facing loss, and they got a huge margin call. And in the first month itself, their entire 40% of the overall capital got vanished. Okay, initially they were making huge profit. If you look at this section, the position that they are talking about, the spread differential. Why? Because two government bonds, for example, a British government bond and a EU government bond, or a Brazil government bond. If they feel that both of them are going to be more or less similar, in one case if the price is very high, in one case the price is very low, they'll take position. Again, for this you need models. Okay, so they tried to explore opportunity across, okay, EU, German bonds. So for example, they started buying Spanish and Italian bond, they started taking short position in German bond. Okay, similarly, the interesting part was this: they started taking short position in the US Treasury bond. assuming that the price will go down. But when the crisis happened, the flight to quality happened. That means everybody started buying the German bond, German bond and the US bond, and prices started going up, and they had taken short position, and that is where they started facing an issue. Okay, so flight to quality is very, very interesting. From this chapter, 2 question is easily expected. Yes. So more or less, this is basically talking about the broader the numbers, basically $3.5 billion loss and all that. 90% of the control came out. 40% of the capital got vanished in the 1 month, like that. So this is not very important. The major, see, I talked about the issue, flight to quality, this one, economic leverage, that can get tested, and then the lessons can get tested. What led to that failure? Okay, this one in the model. So they also anticipated that the market can behave in a particular way, but and to incorporate that, they had incorporated correlation between the assets or the position that they had taken, but they never anticipated the correlation is going to be so high. Okay, so they were not ready for that. So even though they had adjusted, the real correlation was way high, which led to this economic shock. Okay, also they did not forecast properly the volatility that could actually happen. Basically, their model was correct, but their assumptions were wrong into the model. Okay, and because of which the LTCM kind of collapsed because they had taken the historical data, but the reality was very different than the history. So that has been highlighted. Also, they did not have good amount of capital available. Okay, which could have protected them. So they were also facing liquidity risk because they did not have sufficient amount of money to manage the margin calls. Okay, so the lessons, very, very important. All of the specific lessons. Monitor correlation. So correlation can go up to very high level, historically high level. Okay, so make sure that you have comfort over there with respect to that part. Watch liquidity. You need to have, make sure that short-term storm that you might face, short-term impact that you might face, you need to have sufficient amount of liquidity available if you have taken a high leverage, because when you take high leverage, a smaller change can immediately wipe out the entire capital. Okay, so leverage is a very, very important part. That means it is a two-sided sword. If you don't take care of it properly, it can harm you itself. Okay, next is, if you are entering into position, make sure that it is possible for you to liquidate and exit. Okay, the market impact was amplified, and so this is more or less a repeat. VAR, see, they calculated 10-day VAR, but in reality the situation changed very fast, so they might have to ask for a smaller VAR. Ideally they should have calculated VAR with a smaller time frame, which could have protected them to identify the risk. Okay, but the 10-day VAR was far too short to survive the short-term impact, or basically the VAR calculation logic was not correct for them. Enhanced disclosure, because it was a hedge fund LTCM, so regulators were not aware about it much. Initial margin, this is nothing but your economic leverage. So majority of you should be taking, or basically the brokers should be taking initial margin. They should not be waived off, because that is one cash or liquidity that is available that will protect you. London Wales, kind of fraud, you can think of it. Okay, chief investment officer. Okay, he made a lot of created a loss for the entire organization. Okay, he made a lot of bets on the synthetic derivative, and that was not shown in the risk reports. Okay, and also the way he was calculating. So the case, this is not a very important case as such, because there are other cases also, good high level cases. But what we want to identify over here is that when they were doing the analysis or doing the valuation, this one, they adjusted the valuation methodology of the synthetic derivative, because they have taken a huge risky bets, and when you adjust the valuation approach, what happens, you realize, or you show that the positions are not risky, basically. Okay, so he was cherry picking the pricing. There was, ideally you should be taking the midpoint, but he was not doing that, and this basically created a lot of problem. Okay, a lot of times he was adjusting the VAR number also, so that it does not get triggered in your risk reports. Okay, and if you read this entire section, you will realize that at an overall level, when you made this correct, when they got an external auditor to check and all, and they revised the valuation, they realized that they faced huge losses. Okay, even when they were doing this was a routine breach. That means most of the time they had breached the risk limit, but it was not getting reported, because the chief investment officer was taking care of it. There were 330 breaches that were reported, during this period of time, but he did not take any step because he was involved. Correct? He was involved in the fraud. He also decreased the calculation of VAR by 50%. That means the amount of capital you are keeping to buffer. Okay, highlighting that nothing is wrong, everything is good, there's no risk that we are facing, hence the VAR number is going down. So all of this created a problem. Okay, not so important case study as such. Bearing banks, very important, double star, very important case. This has been tested historically also. Okay, Nick Leeson working in the bank, he was also doing the front office and the back office for the Singapore Stock Exchange. Okay, so a lot of the proprietary trading desk he was managing, and he had taken position explicitly. Initially, he had taken an arbitrage position. Okay, lot of he was taking speculative bets also previously, and whatever losses he was booking, he was not showing it in the report because he was managing the back office also. So all the losses were shown in the hidden accounts, but the profit was shown to the company. Okay, so he primarily took position into Nikkei, which is a index on the Japanese market. Okay, and he had ideally initially taken long short both, but then he thought that let me speculate, and he took long. Okay, but there was an earthquake in Japan. When the earthquake happened, the price went down, and he had taken excessive long bets, and the price went down. It created a huge loss, and that loss was very big. Okay, that created a huge margin call for the bank. Now over here they are highlighting how much profit he had shown. Okay, he had shown 102 million euros profit, but actually the loss was this much because he was doing a fraud. He was not managing, showing the accounts properly. Okay. So, and because everybody was comfortable with this trading activity, nobody questioned him. So there was a supervisory issue also. That means nobody was there to manage him. That also created a challenge. Okay, and he reported an unusual profit of 10 million in a single month, and this concern was again dismissed. People were raising questions. Nobody asked that question. Nobody asked that problem. So what are the major lessons that you found? This lesson is also very important. If you find some abnormal behavior, you should be asking questions. Okay, if there is any strangely deviation from the in terms of return also, you should go and do investigation. Nobody should be able to manage front office and back office because independent verification will not happen. There is a very high chances that the fraud will happen. That is why this case is very important, my friends. Do not ignore this. Okay, let us move forward. Now the cases are very small. Okay, they've talked about financial engineering, Quanto option, Quanto swap. Not heavily tested. Level 2 they can ask you. So Quanto is nothing but it's a combination of call option and a forward option, forward position. So suppose I've taken a call option on Japanese index, and I also have a forward contract that whatever yens I'm going to earn, if the call option is in the money, I'll convert that back into USD or INR, basically whichever currency I'm into. So it's a combination of that. That is called financial engineering because you're combining two different derivatives in one new derivative. Okay. Bankers Trust, basically this was a case of mis-selling. Okay, so they convinced Procter & Gamble to enter into a transaction in which if the interest rate changes, okay, then a kind of a swap where the Bankers Trust will get money from P&G. Okay, so you should know this in a series where BT will pay P&G a fixed rate in return for floating rate from P&G. So when the floating rate started going up, what happened? Unexpected increase was driven by Fed, and when this started happening, BT was very happy that they will get money from P&G, and that triggered the incident that okay, why we are losing so much money? Because you were missold the product. Okay, and there was a huge investigation, huge reputation damage for Bankers Trust also after that, because they realized, P&G realized we were now actually not hedging, we are actually speculating. Okay, and they won around $78 million from that lawsuit. Orange County is very basic example, not tested as such in the exam heavily. It talks about that the treasurer, or basically who's managing the treasury operations. Okay, he had borrowed lot of money in repo, around 12.9, and he already had $7.7 billion of asset. He borrowed more money and he decided to enter into inverse floater. Now, what is inverse floater? See, inverse floater may, if the interest rate goes up, in a normal floater, what happens? If the interest rate goes up, the actual interest rate, your coupon will also go up. But in an inverse floater, if your interest rate goes up, your coupon will become smaller. Okay, so the person did not realize, Robert did not realize the true riskiness of the product. And because of which, what happened? When initially the rates were very low, and hence they were able to make huge profit into this, the coupon was very high. and he was able to make better returns. But when the interest rate started going up, the coupon started coming down, and they realized that they had no understanding about the product, and they lost a lot of money, and they had to file for bankruptcy. So interesting part is this last thing, that they did not understood the riskiness of the product. Okay, they did not understood the riskiness of the product. Okay, inverse floater, I'm just giving a quick review again. Inverse floater simply means if the interest rate goes up, your coupon will become smaller. Okay, and that is what happened in this case also. So Landsbank is very similar, heavy exposure into your corporate, your OTD model, your securitization model. Effectively what happened, they saw that there's going to be huge profit, but then the market started going off. They had huge position in the off balance sheet entities, and which they realized they cannot hold. Okay, so they ended up holding a lot of those assets into their books, which was not possible for them to sell. Okay, and huge losses they had to face. Okay, that has been highlighted, not so very important is such. Reputation risk, in this case your Volkswagen case is very important. Okay, mark this as star. Basically Volkswagen, basically when they had a car in which they had a software, and the software was showing while the time of testing that the car is doing good. Okay, but in reality the car was not good, and they knew about it, and they were just showing it because they wanted to they want to come out with the testing testing part in a very beautiful manner. Okay, so they wanted to show that the car is doing wonderful, because the software was rigged, and because of which the carbon emission that the software is showing was very low in the testing, but in reality it was very different. So if you read this, during the screening and all, it was coming out with flying colors, but the software stopped emission controlling when it was actually used by the consumer. And when this later came out, they had to call back 10 million cars worldwide, and there was fine, there was litigation, the damage to the reputation, which is now made in Germany. This can get tested, and they have tested similar concept also, they have tested in the exam. Corporate governance is more like how you manage the company. Okay, so Enron is one case that was also tested in the past exam, where Enron was the poster boy of American companies, a very big company, huge branding, okay, during the early 1900s and all. Okay, by December 2021 they realized the company is fake because there was an accounting fraud. They had taken huge amount of debt through derivative which they never showed on the book. There was a problem. See, these issues is what you need to understand. Agency risk, people who are running the company, they had some other interest, and the interest did not match with the shareholders. This created an issue, right? Lack of board oversight, people who are running the organization, they are also the chairman of the organization board. So what happened? Nobody is questioning them. Okay, that is the problem. Accounting fraud, basically they use special purpose vehicles to enter into derivative position and borrow money, okay, debt, and which they were not showing into the book. Okay, a lot of fake sales happened. Okay, and if there is a loss, if I'm selling, I'm showing that the sale has happened today, but in reality the sale was not happening. And when the sale happened, actually if I'm facing a loss, I'm showing it in the separate account. So basically I'm manipulating my accounting records. Revenue recognition is also very strong, which basically means that the moment you produce, you are showing a sale. In reality the product is still with you. Okay, it is getting deployed later on. Auditors, one of the big fifth which was there, Arthur Andersen, that collapsed. They were fined, and they were banned from doing all of the activity because they were involved into this fraud. Okay, cyber attack means SWIFT case is also important. So Central Bank of Bangladesh, they had an account with Federal Reserve in which they had kept some money for all the international transactions that could happen. So one of the hackers, they basically hacked the employee's account, and SWIFT codes and SWIFT ID password was taken into account, taken to that section. They started moving money. Okay, and they had some malware through which the emails that were coming in, when you send, you get a trigger notification that was also getting automatically deleted. So I think so they were planning to siphon off around $1 billion, and they had taken around $81 million. Okay, and suddenly somebody realized that there is some problem and they stopped. So they were able to protect, but the losses were very big, and the money was routed through casinos, and hence they were never in a position to get back. How many questions should we expect from this chapter? Like I said, 2 questions or maximum 3 from learning from financial disaster. Very important. So we have kind of completed this chapter. We're going to move towards anatomy of great financial crisis. Again, very basic chapter. Okay, focus is on, for this chapter to be good, you need to be clear on what is happening with respect to your mortgage and mortgage-backed securities chapter. Okay, you need to be clear. So initially the home prices were very low, but the cheap money came into picture. The whole interest rate were kept low. The underwriting standards were reduced. So the entire housing market started increasing. Okay, one of the factors was securitization. What is securitization? Basically, you package. Okay, you create a pool of the loans. Okay, and then you create a new instrument called as MBS, mortgage-backed security, and then you sell this to the investor. Very, very basic concept. Okay, then you sell it to the investor. So when this started happening, whoever was creating that pool, the 1,000 loans, for example, nobody was concerned how this 1,000 loan were, whether those 1,000 loans were actually good or not, because the originating entities, they were only concerned that can we pool them, okay, and can we create a new MBS and sell. So they relaxed standard was one of the section that they realized that this is a problem, and the relaxed lending standard happens, and the interest rate was also low, because then a lot of people started going for home loans, and they got home loan also very fast. There were a lot of pin codes in a US who were initially not getting loans, but because of the securitization, the loan was easily accessible to them. And when this started happening, what was the case? A lot of these pools initially were made of prime customers, good customers, but subsequently a lot of subprime customers started becoming a part of this. Okay, a lot of subprime customers. Now this is a problem, because these subprime customers have some issue. For example, they might have issue with respect to their loan to value is very high, or they do not have sufficient amount of asset available. So that created a problem, because these subprime customers, okay, they become the part of the pool, and they were given loan at a teaser rate. Okay, this is called as adjustable rate mortgage. So teaser rate matlab the initial interest rate is very, very low, 1%. But after the teaser rate ends, the interest rate is going to be very high, 10%, 15%, like that. So they will end up defaulting, and that is what actually happened. Okay, a lot of these subprime loans, they started experiencing losses, and the bank started facing an issue. Okay, a lot of these institutions, they were unwilling to lend those reserves or the extra capital that they had kept. Okay, that capital itself was not sufficient to take care of it. Okay, so they had to enter into liquidity support from the regulator or the government. Okay, and one of the reason they were not having the liquidity, because they had purchased these long-term asset using the short-term liability. If you remember, asset liability mismatch, that has basically been highlighted, and they were not able to roll over the short-term liability because the entire market collapsed, entire commercial paper market collapsed, repo market collapsed. Okay, then the US regulator had to intervene, and okay, we will buy your commercial paper, we will lend you money. Okay, the two large mortgage-backed security companies or people or government entities who were actually helping to create this MBS product, this Freddie Mac and Fannie Mae, both of them were actually privatized. The government had taken a complete control, because they were getting, they were on the verge of collapse, because the claims that were very high. Similarly for AIG, okay, these companies also had to be intervened by the regulator, or else that would have created a fall of the company, and that would have created more systematic impact. So what was the issue in the subprime mortgage crisis? Okay, so look at this. I've talked about teaser rate. Majority of these loans were 30-year loan, in which the first 2 years the rates are very low, but for the next 28 years the rates are very high. Okay, and a lot of these customers were such that they were given 100% loan to value. That means you don't have to pay anything, just come, take the loan and enter into the house. No 0 rupees. Okay, that is not good. Okay, some of the loans that were issued to the customer, were interest only loan, and when you give interest only loan, the EMI is very less. So what happens? You end up facing a huge loss or default when there is a time to pay the entire amount. Okay, at the maturity. A lot of ninja loans, liar loans. Ninja loans are there's no job, no income, still you're getting a loan. Liar loans means you are forging your documents to get the loan. That was also happening. Okay, a lot of home property buyers, what they were doing speculation. They were buying the house, they were selling it at a high price, because home prices were increasing very fast. Nobody realizes that this could stop sometime, and this would create a problem. That is the one part that they talked about. Negative equity also, that you should know. Waterfall structure, broadly you should remember what is the waterfall structure. The senior mezzanine equity tranche, that you should know, more or less. Okay, compensation structure, that means the parties which were involved in between, they made a huge profit from this entire section. They were not worried about the quality of the loans that are going in. Okay. Short-term funding, this is nothing but asset liability mismatch. So they were issuing short-term liabilities. Okay, that means they were raising money for a short period of time and they were investing into assets. So this created into an asset liability mismatch. Okay, and how they were raising money, this is what can be tested. Take asset-backed commercial paper or repo. Okay, commercial paper is nothing but a short-term security where generally commercial paper is unsecured. But if it's an asset-backed commercial paper, it is secured. But what happens is that you raise money for a very short period of time, 90 days, 180 days, like that. Okay, asset-backed commercial paper, it has a collateral. Your collateral could be a pool of credit card loan, pool of your home loans, like that. Repo is very, very simple and basic. So I'll just give you a gist. So for example, there is company A wants to borrow money. So they will say, okay, take this asset from me. Okay, and the company B will give you $100 without any haircut at time 0. And at the time 0 itself, they will sign a contract that A will buy back the same asset, same asset after some time. Okay, and at that time the A will pay slightly higher, say 103. So $3 extra. That $3 is the repo rate that you're paying, extra percentage that you're paying. Okay, so repo rate has to be decided from the start. Slightly higher price you will pay at the maturity. Even if the borrower fails, there's no problem, because even if the borrower fails, you still have the asset collateral, you can just sell now. Okay, generally you don't give the entire money. If you're giving an asset of $100, you'll hit an haircut, say around 10%, and you only give $90. That is one thing that you should know. Both the points are commercial paper and something, this both the things you should know. Okay, the banks that had sponsored the SIVs, they started also facing. So backstop line is nothing but, suppose Citibank has a special purpose vehicle. If a special purpose vehicle actually fails, they had a contract with the original company that if I need capital, I need liquidity, you will have to give me the liquidity. That is called as backstop line. And because see, Citibank cannot let the SIV default, because if that default, because it has a brand name, that is also going to have an impact. Correct? More or less is okay. LIBOR overnight index swap, this basically tells you what is the riskiness in the market. If the spread is very huge, okay, that basically tells me that OI spread, which is a secured one, okay, it is going down, but LIBOR, which is unsecured, is going up, which means people are afraid. It highlights what is the systematic risk in the market. So initially it was close to 0, but then during the crisis it went to 3.6, 360 basis point gap. Okay, higher the spread, higher the credit risk, or higher the riskiness in the market. That is what you should remember. Central bank intervention is not very important. They have just talked what program they had to cover the losses or cover the institutions. Okay, so this is where we complete the chapter. I hope everybody online is with me till this point. सब लोग हैं? So this last chapter of the book 1, Code of Conduct. Okay, see, ideally, even if you read this entire section, okay, you will not be able to answer the questions. Okay, so the best part is solve as much question from this chapter as possible. Okay, I've already highlighted, there's one more video where I've highlighted which point is important and they can ask a question. So it's going to be scenario driven question. Okay, very, very less chances that they might ask you if there is a violation, what will happen, but they will ask you scenario based questions. Okay, like, okay, the most likely is going to be like, you're going to get a gift. What will you do? Will you accept? Will you reject? Is there a violation? Like that, they can ask you. Okay, cultural difference can also be tested heavily. Okay, so more question you solve, the better it is. There's nothing more to explain. It's very logical over here. Like you have to do full and fair disclosure. There should be no conflict of interest. No personal confidentiality should be maintained. The personal information of the client should not be misused. So more or less very basic part. Facts and opinion can also get tested in your exam, whether the facts and opinion are actually bifurcated or not. So violation is very simple. They will temporary suspension. They will remove the GARP membership. They will remove your authority to use the FRM and all. So very basic. So from the exam perspective, my suggestion is that this chapter has to be only solved. So we have kind of completed your book 1. Tomorrow we'll be starting with book 2. Okay. I hope everybody is with me. What action should be disclosed to client regarding trading activity? What? Because there was a question whether the manager should disclose the trading activity or not. If there is a written approval from the client, then only you can disclose. If it's a regulatory body, if it's a government body asking, then you have to disclose very clearly. So you can solve these questions. These questions very important. The CARP, SCR, the Swedger question. Okay. So I hope everybody is good till this point. See, I am taking a lot of efforts for you guys in terms of taking this Maha Revision. I want you guys to clear the exam. Okay. Do not waste time. Have a positive mindset. Okay. Read the Swedger book properly. Solve the mock papers, and I want you guys to clear the exam. सुना ना? Okay. So thank you very much guys for joining in. We're going to be closing the session for today. If you like the session, do like the video, do share the video to your friends, okay, who are preparing for the exam, and do subscribe to our channel. Okay, do subscribe to our channel. Okay, so